Dreaming of retiring early, living financially free, and enjoying your best years in the U.S.? As a New York-based financial advisor with over 20 years of experience, I've helped hundreds achieve that dream. In the next 15 minutes, I'll share 5 detailed secrets, backed by data and real U.S. client stories, to kickstart your early retirement journey today. Hello, I'm a financial advisor based in the U.S., and for over 2 decades, I've guided investors from New York, California, Texas, to Florida toward financial freedom and early retirement. In the U.S., where living costs are high, think $4,500 per month for a family of 4 in California, and markets are volatile, early retirement demands a smart, disciplined financial plan. Today, I'm sharing the 5 secrets I've used to help hundreds of clients build wealth, navigate tough market periods, and retire early. These secrets are grounded in my experience, reinforced by Wall Street research, and illustrated with real stories from my U.S. clients. Let's dive into each secret in detail. Secret 1. Asset allocation drives over 93% of investment success. When I meet new clients in the U.S., they often ask, which stock should I buy, Apple, Tesla, or Nvidia, to get rich quick? But the truth is, picking individual stocks isn't nearly as important as how you allocate your assets. A landmark 1986 study by Brinson, Hood, and Biebauer, published in the Financial Analyst Journal, analyzed thousands of U.S. portfolios and found that 93.6% of a portfolio's return variation comes from asset allocation. How you split your money between stocks, bonds, cash, and other assets like real estate investment trusts, REITs, or gold. Stock picking? It contributes just 3.6%, and market timing is even less at 1.8%. Take my client Michael, a 35-year-old software engineer in San Francisco. He invested his entire $250,000 savings in tech stocks like Amazon, Netflix, and Zoom, hoping for 20% annual returns. But during the 2022 market downturn, when the Nasdaq fell 33%, Michael's portfolio lost 35%, or $87,500. He called me in a panic, ready to sell everything to cut losses. I explained that a 100% stock portfolio was too risky, especially in volatile markets. We rebalanced his portfolio to 60% stocks, mostly the S&P 500 ETF SPDR SPY, 30% U.S. Treasury bonds, via iShares IEF, and 10% cash in a money market fund, Vanguard VMFXX. When the market rebounded in 2023, Michael's portfolio gained 24%, reaching $280,000, and he felt far more secure with lower volatility. Vanguard's Principles for Investing Success, 2023, report backs this up. From 1926 to 2022, a 100% stock portfolio in the U.S. averaged 10.3% annual returns, but with high volatility, standard deviation 20.1%, meaning you could lose 30 to 40% in a bad year. In contrast, a 60% stock/40% bond portfolio returned 8.7% with only 10.2% volatility, significantly reducing risk. A 2022 Morningstar study also found that U.S. investors using low-cost index funds, like Vanguard VTI, with a 0.03% expense ratio, outperform stock pickers by 1 to 2% annually over the long term. Work with a fee-only fiduciary financial advisor in the U.S. to build a portfolio tailored to your age and goals. If you're under 40, consider a 70 to 80% stock allocation, e.g. Vanguard VOO or Schwab SHB, for growth. If over 50, increase bonds like iShares AGG or Vanguard BND to 40 to 50% to preserve capital. Skip hot stocks. Low-cost index funds are safer and more effective. Secret 2. Control emotions to avoid major losses. Investing in the U.S. isn't just about numbers, it's about managing your psychology. The U.S. stock market, from the S&P 500 to Nasdaq, can be a wild ride, and volatility often triggers panic. Dalbar's 2023 quantitative analysis of investor behavior found that from 1993 to 2022, the S&P 500 averaged 9.8% annual returns, but U.S. individual investors only achieved 4.9%. Wow. They sell during market crashes like the 2000 dot-com bust, 2008 financial crisis, or COVID-19, and buy at peaks, like 2021 before the 2022 dip. Imagine a $600,000 portfolio losing 25%. That's $150,000 gone, enough for a Tesla Model Y in the US. That feeling can push you to sell to protect what's left. My client Emily, a 45-year-old high school teacher in Chicago, nearly sold her entire portfolio during the COVID-19 crash, March 2020, when the S&P 500 fell 34% from 3,386 to 2,237. Her $350,000 portfolio dropped to $231,000. She called me in tears, wanting to sell to avoid losing more. I urged her to look at history. After the 2008 crisis, the S&P 500 fell 57% but recovered 250% over the next decade, reaching 2,700 by 2019. I encouraged her to stick with her 65% stock, Vanguard VTI, and 35% bond, Vanguard BND, portfolio and keep investing $500 per month. By December 2020, the S&P 500 hit 3,756, and Emily's portfolio grew to $410,000. The Behavioral Finance Institute 2022 found that 70% of U.S. investors make decisions based on emotions rather than logic, costing them 2 to 3% annually. Another example is Tom, a banker in Boston. During the S&P 500's 15% dip in 2022, he sold his $200,000 portfolio and moved to cash, only to miss a 24% rebound in 2023, costing him $48,000 in potential gains. Build a portfolio you're comfortable with, even if the market drops 20 to 30%. If big swings keep you up at night, reduce stocks to 50 to 60% and add bonds or defensive assets like the SPDR GLD Gold ETF. Create a long-term financial plan and avoid checking your portfolio daily during volatile periods. Use robo-advisors like Betterment or Wealthfront to automate investing and minimize emotional decisions. Secret 3. Time in the market beats timing the market. Many U.S. investors try to beat the market by buying low and selling high, but this rarely works. J.P. Morgan's 2023 study showed that if you invested $100,000 in the S&P 500 from 2003 to 2022 and missed the 10 best trading days, your return fell from 9.8% annually to 3.2%. Notably, 7 of those 10 best days followed the worst days, like during the 2008 crisis or COVID-19. During COVID-19, the S&P 500 fell 34% in 22 days, February 23 to March 23, 2020, but gained 67% from its low within 6 months. My client David, a 40-year-old doctor in Houston, stuck with his 70% stock, mostly Vanguard VOO, and 30% bond iShares AGG, portfolio through this period. He didn't try to predict the market. He focused on retiring at 55. By 2024, his $800,000 portfolio grew to $1.9 million, thanks to compounding and market recovery. Another example is Sarah, a salesperson in Los Angeles. She invested $1,000 per month in the S&P 500 fund Fidelity FCROX starting in 2015. Over 9 years, she contributed $108,000, but her portfolio is now worth $210,000, thanks to a 10.2% average annual return. If Sarah had tried to time the market, she might have missed key growth days. A 2023 Charles Schwab study found that U.S. investors using dollar cost averaging outperformed market timers by 1.5% annually. Use dollar cost averaging to invest regularly in low-cost index funds like Vanguard VOO, Fidelity FCROX, or Schwab SHB. If under 50, allocate 70 to 80% to stocks for long-term growth. Don't try to time the market. Even top U.S. fund managers struggle. Focus on your time in the market, not your entry timing. Secret 4. Avoid forced selling in down markets. In the U.S., high living costs and debts, like mortgages or student loans, force many to sell assets during market dips. 3 main reasons: needing cash in retirement, paying off debt, or emotional stress. During the 2008 to 2009 financial crisis, the S&P 500 fell 57% from 1,565, October 2007, to 676, March 2009. Those who sold at the bottom locked in over 50% losses, while those who held on saw a 400% recovery to 2,700 by 2019. My client Laura, a 60-year-old marketing professional in Seattle, struggled when she retired in 2020 without an emergency fund. When the S&P 500 dipped 15% in 2022, she had to sell part of her $400,000 portfolio to cover living expenses, $4,000 per month, locking in a $40,000 loss. To fix this, I helped her build a $50,000 emergency fund in a money market fund, Vanguard VMFXX, and reduce her stock allocation from 70% to 40%, shifting to the bond fund Vanguard VBTLX. This ensured she didn't need to sell during future dips. A 2023 AARP study found that 60% of Americans over 55 lack an emergency fund, making them vulnerable to forced sales during market downturns. Another example is Mark, a 50-year-old engineer in Dallas, who sold his $300,000 portfolio to pay off student loans for his kids during the 2022 dip, missing $45,000 in potential gains when the market rebounded. Before retiring, build an emergency fund covering 6 to 12 months of expenses, e.g., $24,000 to $48,000 for a single person in the U.S. Pay off high-interest debt, like 20% APR credit cards, before retirement. As you near retirement, reduce stocks to 40 to 50% and increase bonds or TIPS, iShares TIP, to preserve capital and avoid forced sales. Secret 5. Time and compound interest are your greatest weapons. In the U.S., compound interest is the most powerful tool for building long-term wealth. Suppose you invest $5,000 annually, $4.16/month, in a 60% stock/40% bond portfolio with a 7% average return. Using the compound interest formula. After 20 years, $215,000. After 30 years, $510,000. After 40 years, $1.12 million. The first $500,000 takes 30 years, but the next $500,000 takes just 10 years. My client Anna, a 50-year-old nurse in Miami, started investing $500 per month in Vanguard VTI at age 25 through her 401k and Roth IRA. By 2024, she had $1.4 million, enough to retire early and buy a Florida condo. Her secret was starting early, investing consistently, and never withdrawing early. Fidelity's 2023 study found that Americans starting their 401k at age 25 had an average of $1.7 million at retirement, while those starting at 35 had only $900,000. Another example is James, a 45-year-old IT worker in Atlanta. He maxed out his 401k, $23,000 per year in 2025, since age 30. By 2024, he had $1.1 million, enough to retire at 50 if desired. Start investing today even with $100 per month. Maximize retirement accounts like a 401k, $23,000 limit in 2025, or Roth IRA, $7,000. If young, prioritize stock funds like Vanguard VTI or Schwab SHB. If nearing retirement, balance with bonds like Vanguard BND. Use platforms like Fidelity, Schwab, or Vanguard for low-cost, automated investing. Retiring early in the U.S. is achievable with these 5 secrets: smart asset allocation, emotional discipline, long-term market commitment, avoiding forced sales, and harnessing compound interest. I've seen hundreds of clients from New York to California achieve financial freedom, and you can too. Start by reviewing your portfolio, building an emergency fund, and consulting a financial advisor. If this video helped, hit like, share it with friends, and subscribe for more US-focused financial tips. Thanks for watching, and I'll see you in the next video.